Hello there. My name is Carlos Millsap, your wealth building strategist. Hey, I'm here to talk to you about the state of the economy. And in order to do that, what I want to do is be able to share with you a video from a guru, a financial guru, somebody I've been following for a mighty long time, named Tom Hegna. Hegna always have his finger on the pulse of what's happening in the economy. He's going to give us some great insight. Yeah, I can go into a bunch of stuff and talk about it, but that's me. But a lot of times it's great to hear from someone else, someone who's not in the industry. And he is not in the industry. He is not a person who has a life insurance license or a securities license. He's not someone who's selling products. He is a person that is taking an unbiased look at what's going on in the economy and giving people great strategies and to use that is going to keep their money safe, that's going to allow their money to grow. So that's what I want to share with you is his insight. Now, Tom Hegna, as I said, he's been in this industry for a long time. He's a well-noted and well-renowned speaker. He speaks in front of thousands of people. He always, every year, will give a state of the economy of what he sees is going to happen. This video that you're about to look at, he did it in 2023, did around March, but a lot of stuff is still relative to what's happening right now. He started collecting this data around November of 2022, and he usually have this information come out a lot sooner. So he's going to be having some more information come out in a few months, but I want you to listen to what it is that he is saying about our economy. And I want you to be able to get to a point where you're starting to make some smart moves, because you just can't look at things the way they used to be. Things are changing rapidly. And that's the reason why it took him so long to put this video out, is because things were changing so rapidly, and things are going to continuously change rapidly. But look at the indicators that he's talking about. Those indicators are pointing into one direction. And so you need to make sure that you have your house in order that your house of cards won't fall. So let's take a look at what Tom Hegna has to say. And I'm going to be highlighting things along the way. Okay. So let's just take a look here. All right. Get some extra security.
Hey everyone, Tom Hegna here with my 2023 economic commentary. As many of you know, every year I publish an economic commentary video just like this. You can find them on YouTube. I have a free YouTube channel. And normally I just do a video. I just share with you what's going on in the world and the economy. But this is a pretty crazy year. So what I'm going to do is I'm actually going to use some slides, because I think there's some good slides that will help support what I'm sharing with you. So for those of you who were with me last year, you remember that I talked about bubble wealth. The stock market was high, the bond market was high, everything was high, Bitcoin was high, real estate was high. And we talked about how that was bubble wealth, and that you needed to turn that bubble wealth into real wealth. That's what I did with my own personal accounts. I locked it into products where I couldn't lose that wealth. We talked about inflation. It was just hitting the scenes for the first time, and things like shrinkflation and skimpflation, where you used to go down to the store and get 18 eggs, and now you buy 12 eggs and it's more than it was for 18 eggs. That's skimpflation. We talked about interest rates had to go up, that you can't have 7% inflation and have government bonds at 1% and 2%. It made no sense to anybody who knows anything about economics. We talked about government spending, how it was out of control, and that during the pandemic, they just spent way too much money, and they printed way too much money. And of course, Milton Friedman, one of the top economists in the history of the world, said inflation is always and everywhere a monetary event. What does that mean? That means inflation is caused by government printing of money and government spending more than what they're bringing in. And that we did that in spades. And that's why we're seeing all of this inflation. We also talked about the supply shortages, the fact that many of the Chinese factories were shut down due to COVID. That was causing inflation problems. Well, 2023 is very different, okay? And I have a lot to cover, but I want to make this as simple as I can, because I started this presentation back in November, and yet this is probably the latest I've ever released it because things are changing so fast. So I want to keep this on a very high level, and I want to focus on what is really, 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 really important. And this is what's really important. Our country is now $31 trillion in debt. That means every one of you owes 247,000. So I hope you get your checkbooks out and send that check to Uncle Sugar, because boy, do they need it. There's over 1.7 trillion in student loan debt, over almost 1.2 trillion in credit card debt, and maybe the scariest number in here of all, $172 trillion of unfunded obligations for Social Security, Medicare, Medicaid, government pensions, military pensions. These are promises that have been made by our government where there's no money to back it up. Now, why is this a problem? Well, $31 trillion of debt at 1% interest, not a big deal.
So here, first of all, I just wanted to stop and just have you guys understand what he's talking about here. So right now, our country is facing a staggering debt of $31 trillion and rising. You need to understand that this is a problem. It is a problem. And he's getting ready to explain to you why it's a problem. And, because right now it's just a debt that's just growing, and they have to find a way to either slow down or stop that growth. And you may be the key. They may use you, they may leverage you at your expense to stop this growth.
$310 billion of interest. Now that's a big number, but we're a big country. We can handle $310 billion of interest. But at 5%, it's 1.5 trillion. That's a big problem. And we know that it's not going to stay at 31 trillion. And if it hits 50 trillion at 5%, that's $2.5 trillion. Now, I know this sounds like funny money, but let me put this into perspective. The entire United States defense budget, Army, Navy, Air Force, Marines, Space Force is $800 billion. The entire Social Security budget, $952 billion. So you can see we're already paying over $700 billion just in interest. And look at the slope of that line. That line is sloping almost straight up. So this is the problem. And this is why Chairman Powell will not pause, will not pivot. He's going to keep raising interest rates as fast as he can. Why? Because he's got to break inflation. He's got to break the economy so that then interest rates can come back down. Because we can't keep having interest rates high. If we have interest rates high, our country is basically bankrupt. So he's got to break the inflation, and that's why when the market thinks he's going to pop.
Okay, now I want you to understand what he's saying is that inflation has to be broken. Inflation has to be broken, and you need to really understand that in order to break inflation, there's going to be a lot of casualties. There's going to be a lot of people that's going to be hurting financially. You need to understand what this actually means. We're not talking about speculation. We're talking about something that actually has to happen. There's no way around it. But I want to make sure that you're paying close attention to what's going to happen.
He's going to pivot. No way. He even just said they're not even thinking about pausing in 2023. So I think all of this talk of pause and pivot, way too premature. He's got to fix this problem. This is the major problem. Inflation for the first time in 30 years has gone worldwide. And you can see here for the past 10 years in America, inflation was around 2%, sometimes it was under 1%. And then all of a sudden it went to 7 and then 8, and it topped out this summer at over 9%. Now, the good news is it looks like it has topped, all right? And that inflation is starting to come down. But look at how many, he had to raise interest rates 400 basis points just to get inflation down 2%. He's got to get it down to 2%. So he's still got over 5% to go. He's probably going to have to raise interest rates a lot higher than what a lot of people are expecting. Diesel prices are still high. Gas prices are down. I'm going to talk about that in a minute. Diesel prices are still pretty high. Why? Because there's supply issues. There's refinery issues. And if you think about it, everything you buy comes on a boat, a train, or a truck. And all of that is diesel. So prices cannot come down appreciably until we can get these diesel prices down. Now, the good thing is gas prices have come down. So they topped out this summer. Now they're about the same as they were back a year ago. All right, still higher than what they were in the past, but you know, a lot more reasonable than when it's at $5 or $6 a gallon. Lumber prices are down. There are many commodity prices that have come down, and that's what these market people are looking at. They're saying, well, look, all these prices are coming down. The Fed needs to stop. Well, all of these commodities and all these things are only a piece of that CPI. Much bigger is wages and rents. And I don't think wages are coming down anytime soon. In fact, wages continue to go up. And I don't think rents are going to come down significantly. And besides, when you sign a rental contract, normally it's for 6 months, a year, 2 years, 5 years. It takes a long time for those to come down. So I do not see inflation coming down to 2% anytime in 2023. This could take years to do it, but he's got to do it. Our whole country depends on it. And so the Fed is raising rates faster than they've ever raised it. Look at how steep that 2022 line is, and it's going to keep going. He's going to keep raising interest rates. The 10-year treasuries at 3.87 probably should be higher than that. The 2 years at 4.4. So we have an inverted yield curve. What does that mean? Well, normally when you buy a bond, a 2-year bond would pay a certain amount of interest, and the 10-year would pay more, the 30-year would pay more. But it's the exact opposite. Now the short-term bonds are paying higher interest rate than the longer-term bonds. What does that mean? That means the bond market, which I've argued in the past is the smartest market in the world, sees that, yes, inflation is up now, but inflation is going to come down. And so the short-term interest rates are higher and the long-term interest rates are lower because they think he's going to snap inflation and rates are going to have to come back down over the long term. We will see. I think it's going to take longer than what either the bond or the stock market is predicting. But the speed of these raising rates has caused other countries, the UN, to call on the Fed to pause, because see what happens is when you raise.
Okay, now here's the thing. I want you to make sure we understand. So we have a debt issue and inflation issue here in the United States, but it's just not contained in the United States. A lot of times what happens here affects other countries. And then what happens and affect other countries will come back and affect us. So this is something that has to have balance to it. It has to be a strategy but no matter how you face it, there's going to be some casualties. There's going to be some people that are going to suffer losses. So those who prepare, knowing that these losses are going to occur, are going to be the ones that are going to be better equipped or prepared when those times of crisis come.
Interest rates fast. It causes dislocations, not just in the bond market, but overseas in these emerging markets countries. Many of these countries issue bonds that are denominated in US dollars. Well, as we raise rates, the value of the dollar keeps going up. Well, then all of a sudden, these countries have to pay even more to get out of their debt because their currency has gone down against the dollar. And so this causes all kinds of problems. If you remember, back in the 1980s, when Paul Volcker was raising rates, he raised them so high, and then I think Argentina went bankrupt. So the Fed has said they're going to keep raising until something breaks. What does that mean? Well, FTX broke, the Bitcoin place, right? But here's the problem. When things break, there's unintended consequences. You don't know who else is invested in that company or who else has money in that, or maybe even took out a loan and has margin debt in that company. And so once things start to break, then it's like a snowball that can go downhill. But that's what the Fed has said. They're going to cause pain. Home sales.
They're going to cause pain. There's no way around it. And there's going to be some unintended consequences. It may not be meant for you, but it could hit you.
Have dropped significantly. But the good news is they're unlikely to crash like they did in the last one. Because if you remember in 2008, 2009, this is the betterhomeowners.com. They say it's unlikely that home prices will crash. Last time, the main reason was subprime loans were everywhere. Well, right now, there's not many subprime loans. And many people own their house for cash, by the way, so they're not going to have to sell. And other people have loans with 1 and 2 or 3% mortgages. They're not probably going to sell. And so yes, there's not as much demand, but there's not much supply either. And so prices will likely come down, but likely not crash unless there's something crazy. I mean, you got to remember, There could be anything crazy that happens out there. Like if somebody takes out Putin, well, the stock market will go up. If China goes into Taiwan, the stock market is going to go down. So there are things that can happen out there that we can't predict, that we can't see, that could have a significant impact on all of our lives, housing prices, and everything else. But it was.
So basically, there's a lot of uncertainty. There's a lot of things that can affect our economy. There's a lot of things that can affect your finances. So it's, are you willing to take the gamble that it won't happen when most indicators are pointing towards the fact that it could happen? Or is it better to prepare? Is it better to be prepared for it to happen and it not happen than for you to not prepare for it and for you, let me say this correctly. I want to make sure that I say this properly. So is it better to be prepared and it not happen than to not be prepared and it actually happens? That's a question that you can ask yourself. Is it better to be safe than sorry?
Very interesting because Business Week just had an article on the lessons from Paul Volcker. He was the Fed chair back in the 1980s. And he, everybody thinks, oh, he raised interest rates straight up. That's not true. He raised rates and then things started looking better. He paused. I think they even cut when Argentina or one of these other countries went bankrupt. And then what happened? Inflation took off again and he had to raise more and more and more. In fact, he had to go all the way to 20%. Now you're saying, yeah, but Tom, that was back in the 80s, like inflation was like 15%. Yeah, well, if you go to shadow statistics and they use the same way to calculate CPI today as they did back then, because government changes these formulas. And if you go back and put in our numbers today, the way they were back then, our inflation rate is about 15%. So what I'm saying is interest rates could end up being higher than what the market anticipates, okay? He did such a job. It devastated the housing market so bad in the 1980s that home builders would send him 2x4s in the mail. And he was one of the most hated people in the country. And Chairman Powell could find himself in that position too, because the way that he's going to do this is keep raising rates until things break. He's got to throw people out of work. He's got to put millions of people on unemployment so that they're not driving their cars. And he's got to lower your stock portfolio and your 401k so you feel poor, so you're not out driving around shopping. That's his mission. That's what he's got to do. Honey, the Fed shrank our retirement savings. Yeah. The market's down significantly. And look at this, 40% of all the money in America that's ever been printed was printed in the last 2 or 3 years. I mean, that's
okay, that's worth highlighting. 40% of all the money that's ever been printed throughout history was printed in the last couple of years. That's astronomical. So there is a lot of money out there. There's a lot of money, and you can see it all over the internet that there's just a lot of money out there. And they don't want a lot of money out there. So guess what they're going to do? They're going to start doing some things to get rid of some of that money.
Shocking. That's unbelievable. And it's all of this excess money that has caused the inflation. But now it's a different story. So QE was quantitative easing. That was printing of money. QT is quantitative tightening, basically the shredding of money. So they printed 5 trillion. Now they got to try to shred 5 trillion. Well, when they printed 5 trillion, what did that do for the economy? The economy went straight up. The stock market went straight up. What do you think is going to happen when they put $5 trillion through the shredder? I mean, I think we're looking for some pretty tough times. And because the number one buyer of U.S. government bonds for the last, 5 or 10 years has not been China. That's what a lot of people think. It's been the U.S. Federal Reserve. And now they're not buying bonds. And when they're not buying bonds, liquidity has gone down. And if you ever remember, whenever there's been a major crisis, there's a liquidity crisis. People can't get their money. They can't get the money out. It's liquidity. And so we have we have some of the lowest liquidity we've ever had at a time when the bond market is about the highest that it's ever been. And all of this has had a negative impact on the stock and bond market. In fact, the 60-40 portfolio is one of the worst years in the history of the stock market for the 60-40 portfolio. Now, just a little shameless.
Now, I want to say something real quick here. Tom Hegna is not a licensed anything. He doesn't have a life insurance license. He does not have a securities license. He does not sell any products. What he's basically talking to us about is his own uh, personal, his personal use of certain financial instruments and what he advised other people to use in regards to financial instruments for safety purposes.
Plug here. Back in 2016, I wrote a blog. And I said the 60-40 portfolio is dead. Long live life insurance and annuities. And all I said in that article is, why in the world would anybody put 40% of their portfolio in bonds that were paying like 1% or less? That when interest rates go up, the value of bonds goes down. I said it was ridiculous. It was crazy. It was stupid. Don't do it. I said instead, put that bond money into life insurance or annuities. They give you a bond-like return, 4 to 6%, but they don't have the interest rate risk. Well, anyway, Forbes thought it was a good article, and they put it in Forbes as well. So this has been one of the absolute worst years, because not only have stocks been down, but bonds have been down. You can see in that bottom left corner, there has rarely been years when both the stock and bond market have been down at the same time, and the bonds have never been down this much. The stocks have been down more, but bonds have never, and the combination is probably the worst that we've seen. And, I talked in previous years how there was all these trillions of dollars, $18 trillion of government bonds around the world paying negative interest rates. You had to pay them to put your money in their bonds. Well, guess what? That's almost down to zero. And you can see here, it was a bad year all the way around. The Dow Jones was down almost 9%. The S&P was down almost 20%. The NASDAQ was down over 33%. Europe was down. Shanghai was down. Bitcoin was down 64%. There wasn't much that was up. And it was the worst year ever for U.S. government bonds. And so you can see here, the red years are years when the market's down. The green years are the years when the stock market is up. You can see it's up about 70% of the time. It's down less than 30% of the time, but it can go down and it can stay down. There have been years when there have been 3 or 4 years in a row where the stock market goes down. And it was the worst year for bonds ever. And bonds are supposed to be the safe place. And if you look at many of the companies that were, just killing it in the COVID era, many of them are down 70, 80, 90%. The top 10 holdings of retail investors, I know this is a little small, you can't see it, but things like, the NASDAQ QQQ, Tesla, you got Apple in there, you got AMD, you got NVIDIA, you got Amazon, Microsoft, all of them are down significantly. In fact, the only thing that's up there is the short index. The QQQ short, that means it goes up when the market goes down. That's up like 76%, but everything else was down. And I mean, these are names that you've all heard of, these are major companies that are down significantly. And it wasn't that long ago that we had the lost decade here in America. From 1999 to 2009, the market did nothing for 10 years. Well, the European stock market has been down for over 20 years. The Japanese stock market has been down for over 30 years. What would happen if this market goes down and stays down for 5, 10, 15, 20 years?
That's a question that you need to ask yourself. You need to even look at what's called the sequence of return risk. And what will happen if you get to a point where you have your money in the stock market and you now need to start a distribution phase of your money? Instead of you putting money in, now you're taking money out. What's going to happen to your money when you start withdrawing it to live on? The question is, you need to have how long is that money going to last? You need to have that money stress tested. And that's simply done by doing what's called a Monte Carlo simulation. And that's something that can be ran, and it runs thousands of scenarios for you. And when you talk about Monte Carlo simulation, if you haven't heard about it, it's quite simple. NASA uses Monte Carlo simulation to launch rockets into outer space. Engineers use Monte Carlo simulation to build bridges. You have NIH when it comes to medication. They'll use Monte Carlo simulation to determine how the medication is going to work on people. Then, my favorite of all is that you have the casinos. The casinos like to win. So they have this Monte Carlo simulation. And what Monte Carlo simulation is taking something that's quite random and making it predictable. So it takes thousands of scenarios, and based upon those different scenarios, it's going to tell you or be able to predict the probability of the outcome. That's Monte Carlo simulation. You need to have, your portfolio stress tested so you can see what is the probability of you running out of money by the time you reach a certain age based upon what you think your life expectancy is going to be.
What would that do to your retirement? All right. And those are the things that you've got to be thinking about. And another thing is people don't realize that when the market's down 40%, you can't just go up 40% and be even. No, if you're down 40%, you got to go up 66% to break even. If you're down 70%, like many of these stocks, they've got to go up 233% just to break even. And that's why one of the key things is when you're retired, you don't want to lose money. I want to make as much as I can make, but I don't want to lose what I've already got. I made that decision about 10 years ago because I've made money, I've lost money in the market, I'm tired of losing money, not going to lose money, okay? And so I put my money into products where I don't lose money. And you can see CEO confidence is negative, it's going down fast, and you can see that the earnings typically follows what the CEOs think are going to happen. And so it's likely earnings are going to fall next year. The trajectory of leading economic indicators in the US signals a recession for next year. There's a record number of zombie companies. What's a zombie company? Well, that's a company that is not even making enough money to pay the interest on their debt. And so they're just like the federal government. They just keep putting it on the credit card, putting it on the credit card, putting it on the credit card. This can't last for a long time. 24% of the companies in America in the Russell 3000 are zombies right now. So what you're going to start to hear in 2023 is bankruptcy, 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 bankruptcy. There are going to be bankruptcies. And that's a normal part of the economic process. But here's the problem. We don't know what other companies own that company or had money in that company. And then that's the chain of unintended consequences. And that's when things start breaking and big things start happening, like when we had a Lehman or we had a big thing, if Brazil or Argentina or a major country goes bankrupt, and cause significant problems. Here's the chief economist for the International Monetary Fund. He said,
okay, here's what I wanted. I just want to take a quick break in here real quick. You're going to start seeing some big names that are talking about the economy and what's projected and the probability of certain things that are happening. We don't know what stability a lot of these companies have right now, on what problems these companies are having right now, and how if something breaks, if they have a breakdown, if they have a meltdown, if they have some financial issue, how it's going to affect not only the country, but how it's going to affect you individually. But we just need to know that this is not a scare tactic. This is something that's reality.
Worse is yet to come. And for many people, 2023 will feel like recession. Yeah, probably because we're in a recession, all right? JP Morgan, Jamie Dimon warns an economic disaster may be looming. Jeff Bezos, Amazon, billionaire, says time to batten down the hatches. Elon Musk makes gloomy prediction about the economy. Yeah, and look what's happened to Tesla stock.
Now listen, if you don't think that these people that have a lot of money don't have their finger on the pulse of what's happening in the economy, you're dead wrong. You're dead wrong. So we just need to listen. Sometimes you just have to follow the money. A lot of times some of these financial institutions will try to get us and tell us to put our money in specific places, but that's not where they're putting their money. So what we have to do is not do what they say, but do what they do. Okay.
Just falling out of bed. Bloomberg has a model that predicts recessions, and based on 13 indicators, it points to 100% probability of recession in the next 12 months. All right. So I'm not the only one saying this. There are a lot of smart people saying that we're facing some tough times. Margin debt is near an all-time high. Credit outstanding at an all-time high. People can't afford things and they're just putting it on the credit card and putting it on the credit card. You can see that during the pandemic, the red line went up. So savings went way up when everybody's locked in their houses. They couldn't go anywhere. Now savings has gone down, but look at what credit card and other revolving credit, it's just gone through the roof. For years, I said the only reason the market was going up is because of TINA. And TINA stood for there is no alternative. And that's why people would go in the market. You couldn't make any money in bonds, you couldn't make money in CDs, couldn't make money in a bank account. There's no place to make money. You had to be in stocks. Well, guess what? Now there's a lot of opportunities. In fact, there are some people who say that right now bonds offer a better opportunity than stocks. You've got preferred stocks that are paying 7, 8, 9%. You've got pipeline stocks that are paying 7, 8, 9, 10, 11%. So there, you've got busted convertibles, convertible bonds, you know, like Coinbase or some of these companies that it's 18, 19, 20. I think MicroStrategies, it's at 26% interest or dividend on the convertible bond. And so there are other alternatives now, real estate investment trusts. And so I don't think all the money is just going to rush back into the stock market, because there's other places, safer places, that you can get a decent return. Now, this is nothing new. This is back from 1979. Business Week said the death of equities, how inflation is destroying the stock market. Well, as we know, if you'd have bought in 1979, you'd have been fine today. And I think if you buy, you know, you're going to be fine in 30 years. The problem is people who are in or near retirement, they can't think like this, okay? This is for people in their 20s and 30s. Yeah, you can weather it. You can just close your eyes, you'll be fine. But people who are in their 50s, 60s, and 70s, this is not the time when you want to lose money.
Listen, you're in your 50s, 60s, and 70s. If you haven't already retired, you're in the retirement red zone. Therefore, this is not the time to lose money, because you may never have the opportunity to make that money up again. If you're at the point now where anything that you're putting money in for retirement purposes, and you're not putting money anymore, but you're drawing money down, you'll never recover that money. And in fact, when it comes to the sequence of return risk, if you look at that particular model, not only will you never recover, but you may run out of money sooner than later.
Now, the good news is, if you look on the left side, that's the bond market. Anytime the market has been down significantly, the following year, the market typically goes up pretty good. Same with the stock market. Now, it's not always, but there are significant times when the next year the market goes up. Will that happen again? I don't know. It could, all right? But I'm certainly not going to bet my farm on it. Now, let me just look around the globe just for a little while. You know, in another presentation, I talked about what's happening in Japan and Germany and England. I'm not going to do that, okay? There's two major things going on right now, okay? You can see that the US and China are the two biggest countries out there in the global economy. So I'm going to talk about China. Before I do that, I do want to talk about the Russia-Ukraine thing. You know, I think Russia had no idea what they got themselves into. And they're going to have a big problem, because the Ukrainians are fighting to save their homeland. The Russians are saying, what are we doing here killing our cousins? You know, they're related to a lot of these people. They don't want to be there. You know, they had a conscription, a draft, where they got 300,000 men that they drafted. Well, guess what? 200,000 left the country. Only 100,000 showed up. So they're short on people. They've lost about 100,000 soldiers have been killed. The soldiers don't want to be there. The Ukrainians have much better equipment supplied by NATO and the United States. And so, but you know, that's a wild card, because like I said, if somebody takes out Putin, market would go up. If Putin drops a nuke somewhere, market's going to go down. So that is a hot spot that you want to watch. The other place I think you got to watch is China. All right. Now, China just had their China Party Congress this last fall, and Xi Jinping got another term, which is unprecedented. And what he did was he consolidated power. Here's Hu Jintao, who's sitting to his left side in this Communist Party Congress, and he had him forcibly removed. He was a former Chinese leader. He was more of a moderate. And he didn't just do it in private. He did it in front of the entire Congress. And he has loaded up his cabinet with combat-ready Chinese generals who are hawks, who want to take Taiwan, because Taiwan used to be a part of China, and they still say they are part of China. And so look at his cabinet. Those are all hawk generals, combat-ready, ready to go to war. Now, the reason this is a big deal is in 2021, Xi Jinping said reunification with Taiwan must be fulfilled. He would be a failure if he did not reunite China with Taiwan. And after the Congress, he said China is closer than ever to reunification with Taiwan. A US Navy officer said that China could invade Taiwan this year. Now, I don't know if they're going to. I've been to Taiwan twice. Here's what I will tell you. The Taiwanese people are very smart, but they say similar things to what the people in the Ukraine were saying before Russia came. Do you remember when Russia was massing on the borders? And everybody's saying, oh, aren't you scared they're going to come in here? Oh, come on. They do this all the time. They're bluffing. They're never going to come in. Well, guess what? They came in. When I go to Taiwan, I say, aren't you scared? China's just right over there. What if they've been doing this for 50 years. They're not going to come over. So I see similarities that way. But Taiwan has a great military. They've got some significant weapon systems that we provided. You've got Japan in the area that would help. You've had South Korea in the area that would help. The United States has said we will help. But if we got in a war with China, nothing good comes out of wars like that, okay? So I am concerned about China. And one of the reasons it might happen is that we literally declared a chip war on China. We have banned all these different chip companies from selling China high-end chips that they need for their military weapon systems, that they need for their, their military intelligence systems and all those types of things. We banned it. We even banned Taiwan Semiconductor company, which is in Taiwan, from selling chips to China. And so, China probably will not take that sitting down because they're about 10 years behind the rest of the world in these high-end chips. And so they may say, okay, you don't want us to have chips. We're going to go in there and get our chips. So I'm concerned about China. But what I will tell you is with all the stuff going on, in times of uncertainty, what people crave is certainty. And you can get that in the insurance industry. See, look, I don't sell any annuities. I don't sell life insurance. I own 11 annuities. I have, significant amounts of cash value in my life insurance policies. I've converted my 401ks and IRAs to Roth. I'm not just talking the talk. I'm walking the walk. I have a full unlimited benefits, long-term care policy. I am setting myself up to be successful in retirement, no matter what happens with interest rates or the stock market.
So what he is basically saying is that he's using the 7 laws of immortal money, 7 irrefutable laws of immortal money, to set himself up for success in retirement. These are some things that you can be doing for yourself. It didn't cost him anything to do that. He's going to things that are safe, but he's going to gain, he's going to still get growth. He's not going to lose any money. There's not going to be any potential, but he's playing it safe, but he's not going to lose anything. And you have different options that are available to you.
Or Taiwan or Ukraine. Look at these guaranteed payout rates. These are the highest that we've seen in a decade. Now, what do they mean? Those are not interest rates. Those are guaranteed payout rates. So, for example, if a 75-year-old put in $100,000 into a single premium immediate annuity, they'd be guaranteed around $10,000 a year, every year for the rest of their life. Now, if they want to guarantee that if they died the next day, the money's not gone, well, then they get the 9.3%. So they get $9,300 guaranteed to them for the rest of their life. If they were paid $20,000, they drop dead, the family gets the other $80,000. So, whether you want to guarantee or not a guarantee, that's your decision. But I'm saying when you can get guaranteed payout rates like this, why have so much money in the stock market? I have some money in the stock market, but I don't have all my money in the stock market. And I don't think any retiree should have more than maybe 40 or 50% of their money in the stock market. I think if you have more than that, you got to think about it. And you want to, with payouts like this, you don't have to worry about it. And if you're not going to use annuities and life insurance, if you say, I don't believe in those, I'm not going to use it, then you got to have a buffer strategy. And the buffer strategy means if you have a diversified portfolio, you can take money out. You can take out about 4% a year as long as the market's not down. Okay. So if the market's flat or up, take out your 4%. All right. But if the market's down, you don't take it out of that portfolio. You take it out of a bank account, you take it out of a fixed annuity, you take it out of a reverse mortgage, something that's not going down, okay? Okay,
so here's what he's basically telling you, okay? And we're going to finish up right here. So what he's basically saying is that when you get to the point where you're ready to retire, you need to establish what's called a volatility buffer. Because if you have all your money in the stock, remember, I've said a few times the sequence of return risk. What that basically means is that if you're losing money, if the stock market is down and you're losing money and you're pulling money out of it, then what is going to end up happening is that it's going to accelerate how fast your money goes away. Okay. However, if you have yourself a volatility buffer, which basically means that you have your money, you have some of your money in stock, and you have some of your money into a plan that does not lose any money, that you're going to either get gains or no losses. When the stock market is down, you pull your money out of the other bucket, where you're not going to get any losses, and you allow your stock plan or your stock policy, or stock, yeah, whatever money you have in the stock, you allow that to recuperate and let the stock market go back up before you pull money out of there again. So I just wanted to kind of just share with you once again this video with Tom Hegna, one of the gentlemen that I've been following in this particular industry for many years. And as time goes along, we're going to be sharing other videos of other industry gurus and some of the things that they talk about. Because what it all boils down to is that there are 7 irrefutable laws of immortal money that you need to adhere to if you want to make sure that your money in the long run is safe. Once again, this is Carlos Millsap, Wealth Building Strategist. Look forward to talking to you again in the future. Bye-bye.